Welcome to the 5th LuxCMA webinar. My name is Holger von Keutz. I'm a partner and securitization leader at PwC Luxembourg and also the treasurer of LuxCMA. Today, I really have the pleasure to introduce the ATAD webinar. But before starting, some notes for the best participation. The event will be recorded and questions can be asked using the Q&A function, which you find on the lower right corner. The other point I wanted to mention is if you would like to see us and the slides, it would be good to change the presentation mode by click on the side-by-side view in the upper right corner. Then you can see the slides and the panelists. Okay, the Anti-Tax Avoidance Directive and its impact on securitization vehicles and other capital market vehicles was one of the drivers why LuxCMA was founded in March 19. Many players at that time had concerns about the impact of the interest limitation rules defined in the directive, but no clearance was provided by the tax authorities or other associations. One of the first task forces set up by LuxCMA was the ATAD task force. The aim was to provide a common industry view on the application of the rules on the most typical structures at the Luxembourg market. The outcome was a position paper, which you can see here, and which is published on our website. And this position paper is the first publication on this topic, which is supported by so many major participants. I really hope that also the tax authorities will share the views of the industry. I have the pleasure now to welcome some members of the ATAD task force and the chairwoman, Anja Taferner from EY. Let me just introduce the panelists in alphabetical order, but ladies first, before we present some parts of the position paper. Today we have Anja Taferner, as I mentioned already. Anja is an executive director in the International Tax Group at EY Luxembourg. She heads EY's tax technical committee and focuses on international tax topics such as BEPS and ATAD. Then we have Mathilde Ostertag. Mathilde is a partner at GSK Stockmann, and she heads the tax practice of the Luxembourg office. She has a long experience in international tax planning with a focus on fund structuring, capital markets, and structured finance transactions. She also has a strong ties with the German financial industry. Then we have Marketa Stranska. Marketa is an associate director at Sanne's private debt team, and she is responsible for overseeing the accounting function. Marketa has more than 15 years experience in the industry and specializes in financial reporting for structured finance, securitization transactions, and other corporate structures. Gerard Neiens. Gerard Neiens is a founding partner of the Luxembourg office of Hogan Lovells and heads the tax practice since its implementation. He has also more than 15 years experience in tax and focuses in particular in cross-border tax planning and restructuring, as well as in international and corporate tax law. Last but not least, we have Geoffrey Scardoni. Geoffrey is a partner at Clifford Chance Luxembourg and head of the tax practice of the office. Geoffrey has also, how should it be, 15 years of Luxembourg experience in international tax law and focuses on cross-border financial products, securitization, and fund formation. Before going into details, my starting question is for Anja. I know that there have been tough discussions within the group, that nearly every member had its own view. Some were prudent, some more aggressive. Anja, how did you manage to align them all?
Yeah, thanks, Holger. Very good question. I think we all know that there are as many opinions as there are experts. But in this case, I really have to give kudos to the entire group. Of course, we had different views, but everybody was so driven by the motivation to get to conclusions that would be workable for all of us and bring some calm to the market. But yes, we did not always agree, but we spent hours and hours over a bit more than a year discussing and really looking at topics from all possible angles. And I think what made it possible to get to these conclusions is also that we were not just a group of tax experts, but we have a number of members that bring different expertise and different background to the group and different ways of looking at things. So I'm really very proud of what we have achieved. I think we got to a point where all of us are comfortable with the positions in the paper, which I think is great for the market. So let's now take a look at some of the positions in the paper. But before doing that, I think I want to make sure that we all start from the same basis. So let me give you a quick introduction to the issue. Until 2019, tax was never an issue for securitization companies. They are taxable companies, but because all commitments to investors are deductible, they always defaulted to a zero tax result. That changed as from 2019 when Luxembourg introduced interest limitation rules that also apply to securitization companies. Only SVs that are covered by the EU regulation or that have no shareholder that holds more than 25% are effectively excluded from this. So if we look at the slide, the next slide, Holger, we see that we see two common securitization structures. One is intra-group and the other one is an orphan securitization company. And even though the shareholder in an orphan securitization company does not have control, the orphan securitization company is unfortunately still in scope of the rules. So that was really the starting point. The new interest limitation rules limit the deduction of interest expense that exceeds interest income. So any debt-financed securitization company that does not have straightforward interest income is potentially affected. So think of any securitization company that does not only hold performing loans that were acquired at nominal. I think if you think about that, you already see how big the issue really is. And the law raises so many questions, starting from what is interest expense to what is interest income. And you already mentioned, Holger, the authorities have promised a circular, but it is still not there. And we are trying to fill this void with our paper and hope that the authorities will be able to agree with the positions that we have taken. So if a securitization company does not incur interest expense, so only has interest income, the rules will not be an issue, but that will not be the case for that many of them. So the first questions we looked at are around interest definition. Gerard, could you take us through the thinking of how to define interest?
Yes, sure. Thank you, Anja. It's actually very astonishing that, considering the importance of the notion of interest, that the latter has not actually been defined in the law or has been given guidance by the parentally works. Considering, however, that the law who transposed ATAT is actually based on the recommendation of the OECD BEPS Action 4 report, we considered within the LuxCMA working group that these recommendations could be a good source of inspiration. When looking at the recommendation, actually, from our perspective, there are two items which we should consider and really take as a takeaway. I would say first, payments that are economically equivalent to interest includes those which are related to financing of an entity and which are determined by applying a fixed or variable percentage to an actual or a notional principal over time. And actually, when you look at the recommendation, it's even said that this rule should also apply to other expenses which are incurred in relation to the raising of capital. So that would include, for instance, management fees, arrangement fees, or other similar fees. Another items which can clearly be seen in the recommendations is that you should focus on the economic substance rather than on the legal form. And when you look also at the examples which are given in the recommendation, you see they're typically like fixed or variable interest under a participation loan. You see their issuance premium under a convertible loan. And these examples are also in line, which actually the examples which are given by the law itself, because the latter includes a non-exhaustive list of elements which should be considered as borrowing costs. And indeed, the law only considers or only provides information regarding this term borrowing costs, which, as a recollection, includes interest expenses other costs related, which are economically equivalent to interest, and expenses in relation to financing. So when we analyzed this and we saw that there are indeed certain elements where you get a clearer view on interest expenses, we looked also, okay, to what extent do we find information regarding interest income? And there, astonishingly, no really guidance can be found even in the recommendation themselves. So the notion of interest revenue was a little bit a question mark. So within the LuxCMA group, we came to the conclusion that the most appropriate approach here would be a symmetric approach via analogy to that of borrowing cost. What does that mean? That means that if you have a cost which you consider as interest or as an economically equivalent interest, then a corresponding revenue should also be considered as an interest or an economically equivalent interest. One of the items which can be highlighted there and reflects actually to what extent it can help is, for instance, capital gains. Capital gains on instruments is something which a securitization vehicle can have as well on the debt side as on the income side. So generally, if you are purely looking from an economic perspective, you would consider actually that the capital gain should not be considered as an interest or an economically equivalent revenue to interest. But there might be a situation where, from an economic perspective, you might consider that capital gain is actually an interest. And we will discuss about that later on regarding NPLs. So if we would have, on the other hand, instruments on the revenue side where also you would realize a capital gain, and from an economic perspective, again, you would consider that as an interest expense, then based on the symmetric approach, you would also consider such capital gain as an interest on the income side. So we see here that the symmetry is really key in getting a little bit a clearer view as to how analyze as well the expenses, but especially the income revenues. However, even by clarifying a little bit the notion of interest and interest expense, and by applying the symmetric approach to income revenues, we realized within the group that there are two main uncertainties which remained just by analyzing the provision of the law. I would say the first uncertainty is in relation to one of the examples included in the non-exhaustive list provided by the law, being certain foreign exchange gains and losses which are realized on borrowings or instruments related to financing. Indeed, what does it mean, certain foreign exchange gains and losses? When we looked at the law and the parliamentary commentaries, again, there were no guidance. Even the Action 4 report did not really provide any guidance in this respect, except that they highlighted that foreign exchange gains and losses on instruments to hedge or to take on a currency exposure connected with the raising of financing would, for instance, not be considered as an interest falling within the interest limitation rules. So within the group, we said one of the possibilities is to consider actually that all foreign exchange capital gains and losses, which you might realize on an instrument related to financing, could be considered as falling within the definition of interest expense. And actually this approach could be taken not only regarding the principle, but could also be applied to the remuneration under the instrument itself. Then again, the importance of the symmetry approach, meaning that if you would have the same capital, the same foreign exchange gain or loss on the income side, then again, based on this symmetric approach by analogy, you would consider that this income is also considered as an interest revenue or as an economic equivalent revenue. The second uncertainty, which also provided me some nightmares, was actually the reference in the definition of borrowing costs referring to expenses in relation to financing. And actually this uncertainty was twofold. First, how should we consider expenses in relation to financing? Should we apply a narrow approach or should we apply a large approach? Because when just looking at the reference itself, you could apply it pretty broadly. However, when we looked at the German and English version of the ATAD directive, we saw there that actually there was not a reference to expenses in relation to financing, but there was a reference to amounts in connection with the raising of capital. And actually this reference is pretty narrower than really expenses in relation to financing. So considering the need for a uniform interpretation of the European provision, and especially considering that the Action 4 report, which actually largely inspired the ATAD directive, refers in its English and in its French version to the reference of amounts in connection with the raising of finance, we came to the conclusion that this reference should be applied narrowly. The second uncertainty regarding this reference is actually, and which is even more important, is that it cannot be found in the context of interest revenues or economic equivalent revenues. So this is rather unfortunate because you could consider that here we have actually a situation where the symmetry does not apply. So for instance, if we have a securitization vehicle which on the one hand would receive arrangement fees related to financing and on the other hand would pay such arrangement fees, the symmetry could not work because this reference is not included in the section of interest revenues or economic equivalent revenues. In this context, it's pretty unfortunate again that Luxembourg did not take the option actually like some other countries. Indeed, some other countries included this reference also in the definition of interest revenues. However, if you look at the complement of the Luxembourg tax returns 2019 for the determination of the exceeding borrowing cost, you see therein that actually the taxpayer is required to provide information regarding all the examples which is given in the non-exhaustive list provided by the law, including actually elements like guarantees fees, arrangement fees, and this request is not only in respect of the interest expenses, but it's also in relation to the interest income or to the income of the securitization vehicle. So it seems that the Luxembourg tax administration, at least indirectly, not only adhere to this symmetric approach, but also consider that this symmetric approach should be applied to elements such as management fees, arrangement fees, or other fees, which is, of course, extremely helpful because it would be in line with actually the purpose of the securitization vehicle, which per se should actually be tax neutral generally. So here again, we see that the symmetric approach is key in helping actually to provide not only guidance but also the neutrality, at least to the extent feasible, of the securitization vehicle. Thank you. I'll hand over to you again, Anja.
Yeah, thanks, Gerard. So the conclusion on symmetry, I think, is really one of the big conclusions that we have arrived at in this paper, including a legal basis for that conclusion that we always wanted to get to. But I think it's important that we have found also sufficient technical basis to get there. And one topic where this question of symmetry becomes very important is the question of how to deal with acquisitions of loan assets at discounts. And we specifically looked at two situations, purchase discounts, so receivables that are performing and bought at the discount to nominal to reflect the difference to current market interest rates, which is then usually amortized, and the acquisition of non-performing loans. And in both cases, the question is whether returns above acquisition cost, which in the case of NPLs are very low, as we know, are capital gains or interest income. And we looked at this both from an accounting and a tax perspective. Marketa and Mathilde, could you take us through the thinking on discounts, both from an accounting as well as a tax perspective?
Sure. Thank you, Anja. Good afternoon, all. I think I would not agree more with Anja. If we talk about the most discussed topic within the LuxCMA group in relation to the ATAT implications, we would definitely be looking at the treatment of the purchase discount and closely related topic of treatment of interest and capital income on non-performing loans from accounting and tax perspective. As Anja mentioned, I will be giving you the update brief update on the accounting treatment or the background, and I'm very happy to have Mathilde and to ask her for her thoughts on the tax treatments and related matters as the presentation goes through. So in general, if we are talking about the, let's say, purchase discount, we're talking about the asset which is actually acquired. The acquisition price is highly below the face value of the loan or the debt. The reason for purchasing the debt below its face value is mainly due to the fact that the initial borrower could be facing certain difficulties in meeting its original contractual obligations and could appear itself to be in defaulted or distressed situation.
And indeed, just to give a bit more an explanation on purchase, what we qualify as purchase discount, or when we talk about purchase discount, we are not necessarily in a distressed or a non-performing loan situation, and the discount often as well reflects the difference between the market interest rates and the interest rate applied on the loan.
Correct, Mathilde. And I think from the accounting perspective, if we acquire asset or debt or the loan at the purchase discount, the high importance at this stage for us is to create a strong valuation model which will actually provide us with the basis for assessing of the revenue recognition of the investments, and at the same time will give us a good base for the application of the interest limitation rules. If we look at the purchase discount, or if we look at the transaction itself, when the securitization vehicle acquires the debt at the purchase discount, we can actually be expecting to receive two types of revenues or two types of income. One would be let's say, even not so usual accrued contractual interest, if any. That part of the revenue would be definitely from the accounting looks treatment treated as interest income through the profit and loss accounts. And I hope, Mathilde, you would be confirming the same from the tax perspective, and no, this revenue would not be impacted by ATAT implication itself.
Yes, indeed. This is the most simple situation, I would say. So here, for the contractual interest, the expense from the borrower side and the income from the lender side, there are economically interest between the parties. And here, the economical analysis follows the legal qualification, and there would be no reason to deviate from it from a tax perspective.
Yeah, that's very good news. If we look closer at the treatment of the purchase discounts, we actually have a few options to which gaps we can direct ourselves to. Let me start with the LuxGap treatment itself, whereby we would have three options how to treat the purchase discount. First option would be the discount can be recognized as a profit at the maturity. Second option would be to amortize the discount over the remaining lifetime or term of the loan. The third option would be, let's say, very exceptional case, and it's given that the full purchase discount or the discount would be recognized through the profit and loss account as of the day of purchase. Me personally, let's say, under my sort of thoughts, basically the LuxGap itself is actually very silent when it comes to the respect to the treatment and classifications of the income in general. So my recommendation would be to turn the accounting to different accounting standards, being in this case IFRS and especially IFRS 9, which is actually giving the guidance on the treatment of the financial instruments. Under the IFRS 9, the purchase discount is to be accreted over the lifetime of the loan until its maturity. It's given by the characteristic of the instruments itself, whereby its value until the maturity is increasing and getting closer to the sort of initial par value. The amount which would be accreted over the lifetime of the loan would be actually determined by using of the effective interest rate method calculation. And the outcome of the accounting treatment based on the accretion of the discounts would be in general booked as an interest income. We would need to, of course, include certain deferred obligations, costs, and expenses at the same time as well. If you have anything to add, Mathilde.
Sure. Let's go on the tax side. This is where the discussions among the LuxCMA group were so important, is that we had a good accounting basis on which to rely, but then we had to think about the tax qualification itself. And if you look at the list, and then this is where actually the cornerstone of our discussion and now of our paper is indeed the symmetry approach, which was presented by Gerard. If you look at, for instance, the list of the interest expenses under Article 168bis, the list expressly refers, for instance, to imputed interest on convertible bonds and zero coupon bonds, as well as premiums. And we took the view in the LuxCMA group that by using that, the example could be extended by analogy to original issue discount situations. Then if you apply the symmetry approach, which was presented by Gerard, at the level of the creditor, the recognition of income representing this original discount, issue discount, it should as well be considered as interest income. For purchase discount, here you have to look at the economical rationality or relationship. From an economic point of view, there are no reasons why we tax-wise should deviate from the accounting treatment. LuxGap recognize the accretion over time, IFRS 9 as well, with the effective interest rate as well on the purchase discount. And the same should be as well reflected in the fiscal balance sheet by applying the accrochement, the principle, the accrochement principle under Article 40. The income which would be deriving from the purchase discount and which is amortized would then be treated as interest income from a Luxembourg tax perspective. What is important to note is for the timing on recognition of this income here, we had discussions as well between the group, and we agreed that a prudent approach would be to just follow the account and the accounting appraisal. I also wanted to give just one additional note because we rely on different bases and guidance, and it's also important to note that even if they were not really detailed, there were also some guidance from the CSSF and even the banking industry practice. And they were used for the accretion on discount on securities. And you could apply them as well by analogy to receivables because they follow exactly the same rationale than the one which was explained by Marketa. And talking about the treatment of purchase discount, it is at the same time actually opening a discussion on treatment of return or income received above the acquisition cost, which is by itself very low.
Yeah, indeed, Mathilde. I think for the NPLs and in the absence of the formal definition, what is interest or what are the costs economically equivalent to the interest under the Luxembourg tax law, For the accounting treatment of the income above the acquisition cost on the NPLs, I think I would consider to turn to market standard in the determination of the return on the non-performing loans. I think, as mentioned earlier, it's very important when you purchase the distressed or defaulted debt to set up a robust valuation model. One of the reasons would be that due to the distressed situation, the situation of the initial borrower has actually changed, and the conditions of the initial economic reality are different from those than what we're facing at the time of the transfer. And to be able to correctly apply the interest limitation rules and allocation of the income, we need to reassess the returns to be earned on the debts at the time of the transfer. So let's say that the market standard for the determination of the return on non-performing loans is based on the evaluation of the recovery of the purchased loan or the debt, and afterwards, once we have the maximum recovery amount, we are in position to assess the internal rate of return. The internal rate of return itself give us the information on the return which is expected. Addition, the collections all collections will be made in according to the expectation, and there will be no breach in payments. And in short, higher internal rate of return means that your investment is actually more profitable. So let's say to the extent that this method to assess revenue on your investment is considered to be a valid method, I would believe that let's say any collections which are received up to the maximum amount of the expected or forecasted income from the accounting perspective would be generally treated as an interest income, and only those which are actually above this expected forecasted income calculated, those collections would be treated as a capital gains. Maybe just a last note on the classification on the income on non-performing loans under the Luxembourg GAAP within the financial statements itself. Any income from NPLs is actually classified through the profit and loss account, and in the financial statements on the face of profit and loss account, I would assume that the classification, or I know that the classification would be under the capture of income from other investments, other securities, and loans forming part of the fixed assets. And of course, there is an obligation for further description under the notes itself, which would be giving us more detail on the type of the income, such as classification between the capital gains or interest income and other income, basically. Would there be any sort of idea from the tax perspective, Mathilde, which would actually not be in agreement with the accounting treatment?
Well, here from a tax perspective, we as well can connect to the market standard methodology which you just presented. Here, actually, in a non-performing loan situation, it is clear that the economic reality, it has changed between the parties, and it has changed between the original borrower and the lender relation, the business relationship, and when the NPL is transferred to the new lender, here our securitization company. From an economic point of view, it definitely makes sense to reassess the return to be earned on the NPL according to the economic reality at the time of the transfer. And from a substance over form point of view, then you have to make an economic valuation according to market standards on that transfer date. Why do we here rely on the substance over form principle? Because it is central to Luxembourg tax rules. The law, parliamentary comments, court cases continuously refer to the independence of tax law and tax interpretation, which should rely on the appraisal of the economic reality against or versus legal qualifications or legal constructs when you have deviating views. And here this is quite clear that in non-performing loan situation you have to do a reassessment of the economical reality and the forecasted return on your loan. In the end, I would say for non-performing loans, from a pure Luxembourg tax perspective, there is here as well no sound reason or no specific tax rule which would force us to deviate from the Luxembourg GAAP accounting methodology. And then you go back to Article 40 and the accrochement principle, and there you would also qualify the IRR as income equivalent to interest income on the basis of the forecast income. It should be noted as well that we also got common terms between the LuxCMA group that from our perspective, any income which would be in excess of that initial forecast that you do for accounting purposes, which would be made by the new holder of the NPL, that should qualify as capital gains. This would, from our perspective, follow a prudent and a fair analysis of the situation.
Thank you, Mathilde. And let's say just a closure. As you can see on the slide in front of you, you can actually we highlighted the two different methodologies which we just discussed from the accounting treatment of NPL and purchase discounts. So Anja, it's back to you.
Yeah, thank you. As you said already, this was really one of the key topics that we spent a lot of time discussing, and I'm quite proud that we managed to connect all these loose ends, because that topic has been discussed in various groups within Luxembourg, but bringing it all together, bringing accounting, legal, and tax together, I think was a bit of a challenge, but we got to a situation where I think we're all comfortable with the outcome, and for it also to be applied in practice. Before we move on to the next topic, we received a little question which I'm not sure everybody can see. The question is, what happens in a scenario where interest income is just the reimbursement by originator for interest expense paid by a securitization entity on a loan note issued by the entity? Will we still consider this as interest income under the interest limitation rules? And I think, Gerard, that might fit best with the topic that you covered earlier on. So maybe you could share your thoughts about this.
Yes, thank you, Anja. Indeed, I think I think one of the favorite answers of lawyers are always it's case-by-case analysis. And I think this would also depend here a little bit, because as we discussed in the beginning, I think what would be really important is to really analyze to what extent this interest income by the originator can really be considered as an economically equivalent interest or an interest itself. And for that, in my view, it will really depend a little bit on the legal basis why the originator has actually paid this income, so that we can really consider it as an interest, or whether maybe even though it might from a legal perspective be considered as an interest reimbursement, that economically you would take a different approach. But it really would depend a little bit on the legal basis of this payment.
Thank you, Gerard. So now let's move on to the next topic. Another important one that we often see in practice, securitization companies repackaging funds. We just went through a topic where we concluded that we feel comfortable following the GAAP treatment, and this is actually the opposite. This is a situation where we will not do that in a lot of cases. Geoffrey, could you say a couple of words about the treatment of investments in funds?
Yep, thanks, Anja. That's right. We do see and use quite often, actually, securitization vehicles to repackage fund interest. I think One of the most common example I have in mind is for specific German investors who cannot invest directly into funds, and as a result, we simply repackage the fund units into a LuxSV, so that the investors will simply hold the notes issued by the SV. So I think when the fund that is repackaged is a partnership, means a tax transparent entity, we have to distinguish two situations which are depicted on the slide. The first, which is clearly the most common one, and actually I think which was more or less the only one before ATAD, is where we simply repackage the units of the partnership directly into the securitization vehicle, so that the SV becomes a normal partner or unit holder in the partnership alongside other investors, and that's the example on the left hand side of the slide. In such case, and this is where we are facing issues now, since the partnership is tax transparent, the SV will be deemed from a tax standpoint, and this is where, as you rightly pointed out, we will deviate from the accounting standpoint. Since the partnership is tax transparent, the SV will be deemed to be the holder of the assets held by the partnership directly. That means that if partnership holds debt instruments and derive therefore only interest type of income, it is fine, because then the SV will be deemed to receive interest as well with a look-through approach. However, if we have a partnership which owns any non-interest generating type of assets, like, I don't know, we have a fund of funds, the partnership basically is holding other fund units, for instance, then the interest barrier may very well be an issue, because with a look-through approach, our SV will receive dividends or capital gains, which of course, if they don't qualify for the participation exemption with a look-through approach, will trigger the interest barrier on the deduction side. So the conclusion with this first option is that we have to be very cautious, because the SV will basically inherit whatever the fund itself receives. Now, the second option, the one on the right-hand side of the slide, and the one which is developed in the CMA paper, is much better, I would say. This is where the partnership issues debt to the SV, whilst the SV does not hold any units in the partnership. Right? So the SV will only have debt investment into the partnership. In this case, basically, the SV is in the position of a normal creditor towards the partnership and should not have to look through the partnership. That means that the SV will simply recognize income from the debt issued by the partnership, and such income should then qualify as interest, which is okay from an interest barrier standpoint. So this second option is clearly the preferred alternative, as it makes possible the use of an SV for repackaging purposes, even when the fund would itself derive bad income, to put it that way, from its assets. This can, of course, also be a restructuring option for existing structures which are facing an interest barrier problem. Maybe, a side note on this. Of course, when we talk about funds, we have in mind in this type of setup, the partnership is a fund, we have in mind standard AIFs, but we could also envisage a securitization fund here instead of an AIF, if we want to stay, for instance, outside of the IFMD world, which is also a requirement sometimes for some investors. Again, I have in mind that there's some German setup where they cannot invest directly into the fund, but not even indirectly. So here, a securitization fund instead of a normal fund could be a solution. Maybe as a final point to state the obvious, we are talking here about funds which are structured as partnership, meaning tax transparent. If we have an opaque fund like an SCA RIFE or an SCA SIF, for instance, there is of course here no look-through approach, and the situation is much simpler. Basically, either the SV subscribes to shares in the RIFE, and then we have an ATAD issue, because we will derive dividends and capital gain from the RIF, or the SV subscribed to debt issued by the fund, and then we are back to more or less option 2, where we are deriving interest from our debt investment, which again should be okay. So maybe as a conclusion, I think at the end of the day, when we talk about fund repackaging in SV, I think the situation is rather clear. It doesn't mean that it's easy or ideal, of course, because some situations will remain problematic. That's not the outcome we would like, of course, when we end up with an ATAD issue. But I believe we have a pretty good view on what works and what doesn't work, which, well, just that actually, I think it is already a great achievement when it comes to ATAD, where so many aspects are still blurry to say the least. So I think on this topic, basically our outcome is, well, pretty solid and gives some clarity on this type of setup. So absent any questions, back over to you, Anja.
Yeah, thank you. Yeah, something else that is very common in an SV context is the use of swaps, which result in obligations of the SV to pay on cash flow received on the collateral asset to the swap counterparty, which then pays cash flow needed to meet the obligations under the notes issued by the SV back to the SV. We don't unfortunately have so much time today to go into the details of the treatment of swaps, but still, Geoffrey, if you could tell our audience just a couple of words on how we decided to approach this topic.
That's right. Yeah, from a tax standpoint, and I will keep it very brief, conscious of time. I think the general tax principle is simply to follow the economic substance of the swap, which is essentially to pass on a specific flow. Right. So the result from a tax standpoint should be that whatever is passed on through a swap agreement, this is what we should see on the receiving end at the level of the SV. A swap should not lead to any conversion. If a swap is passing on interest, basically, what should be seen at the level of the recipient should also be interest. I think that the outcome, to put it very simply, is that there is no specific magic here through which we would convert, unfortunately, a bad income into a good income. As Mathilde mentioned it before, substance over form, basically, the swap is simply passing on something without necessarily changing the nature of what is passed on.
Thank you. We just got a question in relation to the discount section that Marketa and Mathilde presented earlier. I will just repeat the question here, and then Marketa or Mathilde, if one of you could answer, that would be great. So the question is, can you clarify if the discount amortized on the performing loan or receivables could be booked as interest on the basis that the expectation is a full recovery of the face value? So meaning without the need for a valuation model.
Well, here my understanding, because this is very much linked to accounting and accounting methodology, my understanding is that you have to apply a different methodology if you book on purchase discount the accretion of the interest, or if you are in a non-performing loan situation. So here my understanding is that the question is really about performing loan situation, where you have a discount which is tailored in, and here by applying the LuxCMA principles and also then the EIR methodology and the IFRS 9, my understanding is that you could book the entire amount of the discount. You could amortize it until the end of the investment. You cannot, from my understanding, apply the same methodology for non-performing loans. That would be perhaps overstretched.
Yeah, thank you. Unfortunately, our allocated time is already over. There would be so many more things to be discussed, and there are a lot of other issues that we looked at and summarized in our paper, including structured products like credit-linked notes or Delta One notes. Without going into a lot of details, we concluded that there are technical arguments that a redemption loss on a Delta One note should not be interest expense. But of course, everything that we've been saying today and in our paper is subject to this not being abusive. And I think it's important to bear that in mind because the tax authorities can disregard a structuring that is tax and not business driven. And that's particularly important in case of a restructuring. I think where a structure was in place already before the interest limitation rules kicked in, I find it difficult for the authorities to argue that this was done for tax reasons. But obviously, if you do something now, you would have to bear that in mind. But with this, we are concluding the technical discussions in this webcast. The next webcast in the LuxCMA series will be on a very different topic, CLO's market evolution, but will certainly also be interesting. But I will let Rolf explain that to you in a bit more detail.
Thank you very much, Anja. So next week, we are looking at CLOs. Is there a market for CLOs in Luxembourg? Is Luxembourg the solution? I'm more than pleased to have industry experts on the panel. We will have Ariane from Hogan Lovells. We have Marie-Isabelle from PwC on the tech side, and we have Atif from TMF on the corporate governance side. So we'll walk through the most recent evolution in Luxembourg and see if we can offer a good product, which I'm convinced we can, but we will tell you more next week.
Thank you, Rolf. I take over for the closing words. A big thank you again to the panelists today and the whole 𝗟𝗃𝗃 or task force in the name of the EXCO of the LuxCMA. It was great work, and we are all happy that we have this paper now. As we have seen, we couldn't cover everything. There are so many things we still need to discuss. Please let us know if there is a need for another webinar on 𝗟𝗃𝗃, where we maybe discuss more the structured products or go deeper in the NPLs or the funds or whatever. Please let us know. Send an email to just the info address of LuxCMA. And I would also encourage all the members of LuxCMA to actively contribute to the working groups and the task forces. We see we have a good result then if we all work together. And for the non-members, I invite you to join the LuxCMA. Thank you very much. Have a nice day and stay healthy. Bye-bye.